Okay, so you want to sell trading cards. Print some cardboard, put athletes or cartoon monsters on it, sell packs for a few dollars each, watch kids collect them. Simple enough. The global trading card market is valued at well over $15 billion, and a single rare card has sold at auction for more than $12 million. Surely this is just a nostalgic hobby business with modest margins. It isn't, not even close. Trading cards have quietly become one of the strangest hybrid markets in the world, part collectible, part commodity, part speculative financial asset, and understanding that combination is the only way to understand how cardboard printed for pennies started trading like fine art and rare currency. Let's start with the number that resets how you think about this industry. A single pack of premium trading cards, whether it's sports cards or a trading card game like Pokemon, can retail for $5 to $500 or more depending on the product tier, and the actual printing and material cost per pack is typically just a few cents to a few dollars. That gap between production cost and retail price exists because the entire business model isn't really selling cardboard, it's selling a lottery ticket, the chance that this specific pack contains a card worth dramatically more than what you paid for it. Here's the part almost nobody thinks about before they rip open a pack. Card manufacturers deliberately engineer scarcity into their products through a system called print runs and insertion ratios. A base card might be inserted into nearly every pack, while a rare parallel or autographed card might be inserted at a ratio of 1 in 500 packs or rarer, meaning the manufacturer knows with mathematical precision exactly how many of each card will exist in the world before a single pack is even printed. This artificial scarcity is what transforms a piece of printed cardboard costing pennies into an asset that can trade for thousands of dollars in the secondary market. So before a single collector opens a pack, there's an enormous business built entirely around grading and authentication. Companies like PSA and Beckett will examine a card's centering, corners, edges, and surface condition, then seal it in a protective case with a numerical grade, typically 1 through 10. This grading process can cost $20 to several $100s per card depending on turnaround speed and card value, and a card graded a perfect 10 can sell for 10 to 100 times more than the exact same card graded an 8 or 9, meaning the grading industry itself has become a multi-hundred-million-dollar business built entirely on quantifying tiny differences in cardboard condition that would be invisible to an untrained eye. Then there's the manufacturing and licensing side, which is where the real structural money sits. A company producing officially licensed sports cards has to pay substantial licensing fees to leagues like the NFL, NBA, and MLB, plus additional fees to the Players Association for using individual athlete likenesses, costs that can represent a significant percentage of wholesale revenue before a single pack reaches a store shelf. This licensing structure is exactly why the trading card market is dominated by just a handful of major manufacturers, because the capital and relationships required to secure exclusive league licensing deals create a barrier to entry that keeps new competitors almost entirely locked out. Now here's the part that explains why this market exploded so dramatically over the past several years. Trading cards started trading less like collectibles and more like financial assets, complete with online marketplaces functioning similarly to a stock exchange, real-time price tracking services, and even fractional ownership platforms where investors can buy a percentage share of a single ultra-rare card without ever holding it themselves. A single Michael Jordan rookie card sold for over $2.7 million at auction, and rare first-edition Pokemon cards have sold for over $5 million, prices that would have been unimaginable to collectors just 2 decades ago, driven by a combination of nostalgia-driven adult collectors with real purchasing power and genuine speculative investment demand chasing an asset class with no dividends, no cash flow, and value determined entirely by what the next buyer is willing to pay. Here's the counterintuitive piece. You'd think the manufacturers printing these cards would be capturing the majority of the massive price appreciation happening in the secondary market. In reality, once a pack is sold at retail, the manufacturer captures zero additional revenue no matter how much that card eventually resells for, meaning the same company that sold a pack for $10 gets nothing when the rare card inside later sells for $50,000. All of that appreciation flows entirely to collectors, resellers, and grading companies rather than back to the original producer, an economic dynamic almost unheard of in most consumer product categories. But this business carries genuine structural risk, and the market correction that began in 2021 and 2022 is the clearest example. During pandemic lockdowns, trading card prices for both sports cards and games like Pokémon surged to unprecedented levels as bored collectors and speculative investors flooded into the market simultaneously, and when broader economic conditions shifted and speculative capital pulled back across nearly every asset class, trading card values for many mid-tier cards fell 30 to 50% or more within a matter of months, wiping out paper gains for collectors who had treated cardboard as a genuine investment vehicle rather than a hobby. So let's do the actual math on why manufacturers, grading companies, and resellers keep pouring resources into this market anyway. A major manufacturer might sell tens of millions of dollars worth of packs annually at healthy wholesale margins regardless of what happens in the volatile secondary market, because their revenue is locked in at the point of initial sale. A grading company processing hundreds of thousands of cards a year at $20 to $50 per submission can generate tens of millions in pure service revenue with minimal ongoing production cost. And resellers who successfully identify undervalued cards before broader market attention arrives can generate returns that dwarf almost any other collectible category, precisely because the market is still young enough, and inefficient enough, that genuine pricing mistakes happen constantly across a universe of literally billions of individual cards. That combination, guaranteed manufacturer revenue at the point of sale, pure margin grading services, and a genuinely inefficient secondary market ripe for informed buyers, is the entire story of how printed cardboard became one of the most surprising billion-dollar industries in the modern collectibles world.